It's the toughest test the nation's 19 largest banks will ever take. How much money do they have? How much do they owe? And now, imagine the worst possible economic news.
A so-called stress scenario.
The key questions on this stress test: what if unemployment rises to 10.3%? What if home prices plunge 22% and overall economic growth drops 3.3%? Most important, under these conditions, what happens to the balance sheet? What does the bank lose from increased defaults on its mortgages, auto loans, and credit cards? The results will reveal how much more money the banks really need, probably from taxpayers, to stay solvent and keep lending.
They want to see, well, if things get terrible and last a long time, will we need extra capital as an insurance policy?
What does this all mean for taxpayers? Probably another drawdown of the bailout funds Congress passed last October. What does this mean for Wall Street investors? Ironically, the stress tests, even by revealing which banks need help, will also signal the bank's true worth and the government's new commitment to keep them afloat.
Hopefully what it will mean for Wall Street investors is they will have more confidence.
Most important, what does this mean for lending? Any of the 19 banks taking new bailout funds must agree to lend more than before.
To meet the credit needs of their customers, even in a stressed scenario.
But there are two very big things Treasury officials don't know for certain. They don't know whether, instead of instilling confidence, they may actually undermine confidence in the banks that fail the test. And they don't know if the remaining $350 billion in bailout funds will cover what these 19 banks really need. Wyatt Andrews, CBS News, Washington.